Hello guys, so welcome to the session for today. And in this session, we're going to discuss two major important metrics, or ideally, I should call three major important metrics to analyze the current market scenario. Right, so I will just share up my screen as well. And this metric is a very critical one if anyone is trying to track the current market scenarios and want to build up a decision as to which market seems to be more attractive as of now, right? That is whether one should go for an equity market or a fixed income market. So, to analyze the current market situations and to know that whether the timing as of now is better for equity markets or fixed income markets, we tend to analyze these ratios. So, the first ratio to start with is your beer ratio. Beer ratio. So, here, beer doesn't mean what you are thinking of, it is bond equity, bond equity to earnings yield ratio. Okay. Basically, your bond earnings to equity earnings yield ratio, right? So, BER ratio basically stands for bond earnings to equity earning yield ratio, right? So, here we are trying to compare whatever return the bonds are giving us versus whatever return the equity market is giving you. Now, it's a very important metric to try to understand, to try to gauge whether the fixed income market is good to invest into at this particular point of time, or the equity market is good to invest into at this particular point of time. So usually, if we talk about the numerator of this ratio, so generally in the numerator of this ratio, we tend to take the bond yield. From where can we find the bond yield? You can easily find it on any of the social media platforms. So here, if you're talking about India, generally for the calculation of this ratio, we tend to take a 10-year bond yield, because a 10-year bond yield usually tends to price in the different macros going around in the market, the interest rate reduction, the fiscal deficit, the current account deficit, and various accounts of macro indicators. So a 10-year bond yield is a very good indicator to price in the market volatility or the market fluctuations based upon the various macro data. So in the numerator, we take a 10-year bond yield, India 10-year bond yield. You go to Google, you have moneycontrol.com, you have Value Invest, you have Value Research, at investing.com. Just type on Google, India 10-year bond yield. You'll get multiple sites which shall give you a same yield as of today. The yield tends to fluctuate on daily basis, on monthly basis, of course. But as of now, the most appropriate yield as of today, we can take it in the numerator as 6.22. So 6.22 is the bond yield as of now, a 10-year bond yield. The question comes how to find out the earnings yield. In the numerator, we have taken the bond yield, the return which bonds are giving you, or the yield being commanded upon those 10-year government bonds, India. But how to calculate this earning yield? This number we have to put in our denominator. Now, earning yield is not your price to earning ratio. Earning yield is not your PAT. It's not your cash flow yield. Earning yield is the inverse of the P ratio. We have talked about that what exactly is a price to earning ratio, right? We have talked about okay, what exactly do we mean by a price to earning ratio and different factors we have tried to talk about, right? But the thing ideally is that whenever we are trying to discuss about a price to earning ratio and we take the inverse of that ratio specifically, right? Specifically, when we are trying to take an inverse of that ratio, we get the earnings yield ratio, right? So let me connect to the other people as well. Wait. Let me give access to the other guys as well. Just a second. Just
Yeah,
take it as a pause and start to allow other people to join in. Give me a second. Another guy joining in too. Let me allow them as well. Got it. Oh, okay. One, two, three. So I'll just start sharing it again. So we're having approximately 45 participants joined in the video webinar from different groups. Yeah. So coming back to this beer. So basically your bond equity earnings yield analysis, talking about the earnings of bond in the numerator, right? The earnings of bond in the numerator. And here in this case, we have taken a 10-year bond yield. So a 10-year bond yield in the numerator and the equity earning yields in the denominator. So our equity earning yield is nothing but it is the inverse of the price to earning ratio. And we all know that what exactly is a price to earning ratio. The price to earning ratio is basically telling you that how much price an investor is willing to pay for a $1 or 1 rupee worth of earning of a firm. We have talked about the price to earning in our different videos, right? Via the curriculum on different social media platforms, price to earning, the PG ratios and different stuff. So what is the current price to earning ratio? So here, ideally in the denominator, we won't be taking the current price to earning ratio. We shall be taking the forward price to earning ratio. Now there's a way to calculate the forward price to earning ratio. So usually in this case, we shall be taking the forward price to earning ratio of Nifty 50 because Nifty 50 being the most appropriate indicator or the benchmark to compare your bond yields with, right? So in this case, if you talk about a 1 year forward price to earning ratio, now also in our curriculum, we have learned about how to calculate a 1 year forward price to earning ratio via the financial modeling and forecasting. But as of now, the number which I give you, right, in terms of trying to understand your 1 year forward price to earning ratio for Nifty 50, your 1 year forward price to earning ratio for Nifty 50 is 20.6 as of today, right? 1 year forward price to earning ratio of Nifty 50 as of today is 20.6. Yeah, Umesh, I'll come back to your questions. 20.6. Okay. So we can't just directly divide 20.6, 6.22 by 20.6. We have to take the inverse of this 20.6. So 1 divided by your price to earning ratio. Your earnings yield is a different metric, where earnings yield is an inverse of the price to earning ratio. So firstly, you need to have the price to earning ratio, and then you need to take an inverse of the price to earning ratio. So 1 by 20.6 gives me approximately 4.88%. It gives me 0.048 by converting it to percentage because 6.22 we are taking at percentage. It's 6.22 percentage. So we need to convert this decimal of 0.048 into percentage. That gives me like 4.88%. The answer comes out to be 1.27. 1.27, right? So basically, what does it mean? It means for a $1 worth of earning or a 1 rupee worth of earning from the equity market, the bond market is giving me 1.27 times. It means the earnings from the bond market or a fixed income market is much better as of now. It might change after months and months, and definitely it will change, right? So, but as of now, the fixed income market is giving you much better return as compared to your equity market, 1.27 times. If $1 worth of earnings or 1 rupee worth of earnings an equity market is giving you, the bond market is giving you 1.27 times worth of that earnings. So usually what does the bigger ratio tell us? It basically tells us that if the ratio is more than 1, if this ratio is more than 1, it basically indicates the equity markets are giving you lesser earnings, or the equity markets are giving you lesser yield and the bond market is giving you better yield. Because mathematically, your denominator is a lesser number and your numerator is a bigger number. So the earning yields or earnings for equity market is less vis-a-vis in comparison to fixed income market. And also we have seen from previous 4 quarters, the earnings of equity market has come down. The earnings have become timid. The earnings are going down, right? We haven't seen great numbers. We have seen lackluster performances, right? Various companies' estimates have been cut down by 4 to 5% for many companies, right? So that is the thing. So basically, what is happening? the earnings estimates have come down. And that's a proven that why the earnings yield have also come down. Correct. But when this ratio is less than 1, when this ratio is less than 1, it means your denominator is a greater number compared to your numerator. It means in that scenario, where equity is giving you more returns, the equity earning yield in that case would be higher vis-a-vis a fixed income yield. So whenever this ratio is less than 1, we can assume that it's time to go for a fixed income market. And whenever the ratio is less than 1, we can assume it's time to go for an equity market. But based upon this, we cannot make our conclusions. We have to see other things in conjunction. Sometimes what happens, many of the analysts or portfolio managers tend to take an inverse of the Beer ratio. That is, in the Beer ratio, we're taking into account the bond earnings in numerator and equity earnings in the denominator. But like what they do? They take an inverse. They take equity earnings yield in the numerator and they take the bond yields in your denominator. So basically, we tend to call it as an equity earnings bond earning ratio. It is just an inverse of the Beer ratio. And the interpretation also tends to get reversed because many of the people in the market have started to use the inverse of the Beer ratio. But it just means the same. It is just the numerator and denominator's positions have interchanged. Earnings yield we know 4.88% as we calculated above. Bond yield will know 6.22. The number comes out to be 0.77 or 0.8 as a round off. Right? Again, the interpretation tends to change. If this number is less than 1, if this number is less than 1, it indicates it's time to go for fixed income market. But if this number is more than 1, it indicates it's time to go for equities market. It is just an inverse interpretation of the Beer ratio. So both of these ratios are technically showing us it's time to go for the fixed income market. But is it really time to go for a fixed income market? Because over long-term horizons, equity market has always given you enormous returns over the fixed income markets. So usually when the analysts have these numbers and they say, as per these numbers, as per these technicals and calculation, the fixed income markets tends to be more appealing. They do one more testing. They do a third testing. In the third testing, what do? They take the difference of the bond yield and the equity yield. That's called as your bond equity spread. What do? They take a bond equity spread. So it's not a ratio. It is just a difference. Bond equity spread. So what exactly are they doing? They're taking the bond yield, which is 6.22. They take the equity yield, which is 4.88. The number comes out to be closer to 1.30. So instead of taking the two ratios as we did a few minutes back, they just take the difference. Bond equity spread. Bond yield giving us 6.22 and equity yield giving us 4.88. The difference comes out to be 1.30. Now here I'm talking from 1929 Great Depression. From 1929 se lekar till as of today, right? Equity analysts and fixed income analysts have been making their strategical and tactical bets, but more of short-term tactical bets based upon these spreads. And this spread is almost at all-time low. And what do I mean by all-time low? When this spread widens, the fixed income market tends to become more appealing. It means when the difference between the bond yield or the fixed income yield and equity yield tend to widen, this number becomes 1.4, 1.5, 1.6, 1.7. Fixed income markets tend to become much more appealing. But when this difference or when the spread compresses, when the spread becomes tightened, right? And the all-time lows had been around 1.27, 1.25. Equity market has given better returns. So via the third one, which is a much better interpretation or much better justification of the previous two ratios, we can see that it is time for equity and not fixed income. Because the spread is coming to all-time low. The all-time lows has been like 1.25, 1.27. This number of 1.30 had been 1.35, 1.38, 1.40 in the previous quarters. The number is coming down. The number is not widening, it is compressing, it is becoming tighter. The spreads are becoming tighter. And when the spreads are becoming tighter, coming towards all-time low of like 1.25, 1.27 since the Great Depression, and always this number has come true. The spread number has come true. Where Beer ratio or equity earning yield can give you a false indication at a point of time, but the spread won't give you. That is why we always do a third check while seeing this spread. That is, the other two ratios, the beer and the equity earning bond yield, give us an indication it's time for fixed income. If someone had just seen those ratios or calculated those ratios, he would have taken tactical bets in the portfolios, right? On the fixed income side, he had been overweight on fixed income and underweight into equities. But since he saw the third metric, the spread between the bond yield and the equity yield, which is coming to all-time compressed, all-time tightening, all-time low, right? It's time for equities. And this has never given you a false signal. Since 1929 depression, we have seen 2000 dot-com bubble, we have seen 2008 global financial crisis, we have seen COVID-19 pandemic, we have seen these days also of correction, right? These spreads have always worked, right? So this is one way by which an equity research analyst or a fixed income analyst or a multi-asset investment specialist is trying to look over markets, or a global strategist also, right? Based upon these metrics and coming to a conclusion, right? Any questions, anybody on this? We had one question from Umesh in the chat box. Z spreads, OAS spreads are completely different. I've talked about the zero volatility spread and the option adjusted spread in the modules, right? It's also available as a basic session on YouTube, right? You guys can watch that. We've already discussed about Z spread and OAS in detail in our live batch of investment banking cohort, right? This we haven't discussed, right? So it's a complete different topic. So don't get confused between spreads. There are different types of spreads: yield spread, corporate spread, Z spread, OAS spread, right? But here generally we talk about the bond equity spread in this scenario, in this session. Okay. Yeah, the spread is 1.3 Ritvik as of now, right? It will come closer to 1.25, 1.27 in the coming months. Not even quarters, but maybe in a few days. Because ultimately this difference will come down. Because the yields are about to come down. First, your fixed income yield will come down because it's expected central banks will reduce the interest rates. But the earning yield will take time. The earning yield will take time to increase. I've taken a very small topic for today, like nothing else to discuss. I'm keeping these very small sessions because anyway, we are done with the investment banking cohort of this batch as well. But any questions as of now on this? If no questions on beer ratio, what I'm planning for the subsequent session, we'll try to do a regression analysis, right, upon your ROE, ROC with the price to earning ratio and price to book value ratio. So that is something I'm planning for next week, a full-fledged regression analysis on Excel for the upcoming week, right? So this is all for today. I'll see you in the subsequent session. Thank you.